Hey everybody, I'm Tom Hart from Paragon Partners. Today we have a special treat, Ryan Ackerholt from Ameriprise Financial, who's a financial advisor who specializes in 401ks and personal financial planning. Ryan, take it away.
Thanks, Tom. Very often people have come up to me and their main focus is, Ryan, I have money in the bank. I don't know what to do with it. This stems from a personal inhibition to be conservative. And for that reason, people want it to be safe. They want it to be sitting in the bank. They don't know what to do with it. And they're most of the time risk averse. Not everybody, but a lot of the time, because again, people aren't sure what to do with it. So the topic here that we're discussing is the topic of capital preservation. And we're going to go over baby steps. Because in the world of conservative, there's baby steps. We can baby step from ultra conservative to moderately conservative. So let me take you to today the steps on which we go from ultra to moderate. So the ultra conservative, obviously, as you know, is in the bank. We have guaranteed accounts, we have CDs, money market instruments, they're principal protected. What most of the public doesn't realize is in this world, we can be principal protected, but at the same time have more upside potential. For example, there's longer term CDs that might be attached to things like the market. Can't lose, but we have upside. Most people aren't aware of instruments like this. Other instruments, such as annuity products or other things, actually guarantee per year step-ups and keep our principal protected even year after year of growth over time. So this is our ultra-conservative. Also in that world of ultra-conservatives, things like treasuries, fixed income instruments. So in a treasury, we're lending money to the government. They're promising to pay us back X%. Similarly, you could lend money to corporations like Apple or IBM. Differences are some people might think, wait a second, is this corporation going to go out of business? So one might assume a corporate bond to be slightly more aggressive than a treasury backed by the government. This again is our ultra-conservative world. Baby stepping up from this guaranteed world is that world of fixed income we just spoke about. Now in the world of fixed income, there's things like not only those individual bonds, but we can invest in mutual funds, a manager actually investing in 1,000 bonds all put together. This doesn't have actually a maturity, but usually will give us a little bit more yield. So again, you can see the baby step from the principal, guaranteed, we know when it's going to mature, to the doesn't have a maturity, but let me get a little bit more yield in this very conservative world. So moving from this baby step of this principal guaranteed world, secure, we know when it's going to mature, we know you're going to get the money back, is again this world of fixed income. In the world of fixed income, there's other ways to invest in these products other than just buying the individual bond. We could buy things like a bond mutual fund. Now in a bond mutual fund, there's a manager trying to get the best pricing, trying to find the best yield for you, and he's buying 1,000 bonds. But there's no given maturity. So what does this mean to you? There is no set date that you know you are going to get your principal back. So what do you get in return for this? Generally more yield. So again, the baby step. We're moving from principal guaranteed or products that have a maturity and are very secure to this world of there is no maturity date, but what are we going to get again? A little bit more yield. Similarly, what people don't realize is in this world, we can also use an institutional manager. We can pay large money managers to buy individual bonds for you and ladder them for you. What you're getting is that security of the maturity, and you're getting professional management picking secure and well-known bonds and looking over the portfolio for you. So again, not as secure as just buying a bond, but we're in this world of having a manager feeling a little bit more secure and trying to get a little bit more yield. Baby steps. The next baby step brings us to a world where we're going to try to bring a little bit of equity exposure into it. Now, with equity exposure, everyone says, oh, the stock markets, they're crazy. I'm nervous. I don't know what to invest in. Diversification, of course, as all financial advisors discuss, is number one what you need to do. But on top of that, adding a little bit of equity exposure is not going to necessarily hurt our overall growth and even necessarily downside. The reason being, even in this secure world of fixed income, of bonds, a couple times a decade, even a bond, while we're holding it, will have a slightly negative year. It will not be like a stock that could be down 30, 40%, but a bond in any given year, a conservative corporate or treasury bond, can have downside if interest rates go up in that given year. What happens usually during that year? There's an inverse relationship with equities. So what does this mean to you? If we were to put 10% of your account, let's say you have $100,000. $90,000 is in these conservative fixed income instruments, and we put $10,000 in an equity fund or some type of instrument. In that random year where fixed income is down, there's usually, now I say usually, an inverse relationship. The 90,000 might go down a little bit, but the equities go up. It's a hedge. This hedge is very important to our overall long-term growth. And this is how we discuss the real concept of capital preservation, especially over time. So I discussed just now a 90-10 split. Now, most money managers, when they talk about the concept of capital preservation, talk about more of like a 70-30 split, or if you really want to be conservative, 80-20. Now, what we do together, when we look at things together, and we look at the right funds, we look at the right instruments, we look at the right allocations, is we look at how they move over time and find where you're comfortable. This is the most important thing of money management, is that you, the client, are comfortable. If you feel a little bit hairy about, I don't like in that 2008, it moved down that much, I'd rather it move down a little bit less, then we make the allocation how you're comfortable. This is how we succeed, and this is how, with capital preservation, we help your funds grow efficiently. Every day I talk to people whose accounts are not invested appropriately for them or in an allocation that they're comfortable with. Please reach out to me so that we can make sure that everything's set up right and that you're comfortable with everything.
Thank you, Ryan. I appreciate you coming on the show. Everybody, this just goes to show us at Paragon Partners, we don't deal directly with finances. However, we could always point you in the right direction. Ryan's contact information will be below the video. Just click on it, email him, give him a call if you have any finance questions. He's always very helpful.